On y'all. Hope y'all had a good day. I hope y'all had a good Saturday. I'm back. So this chapter gonna be 6 avoiding costly mistakes from the book 101 Investing Friendly for Friendly Beginners. Alright y'all, let's get to it. Imagine sitting at your kitchen table watching the value of your investments drop day after day. You feel a knot in your stomach as headlines scream about market crashes and economic uncertainty. Subtly, an urge takes over you. Uh, Subtly, an urge takes over. You want to sell everything before you lose more. But in the rush to act, doubts creep in. Did I just make costly mistake? Did I just make a costly mistake? How do others seem to stay calm and come out ahead? Many new investors face moments like this, caught between emotions and choices that can change their financial future. Fear, the pressure to follow rising trends, and the temptation to react impulsively are common obstacles that can hinder even the best intentioned individuals. Without knowing how to recognize these traps, it's easy to make decisions that erode hard-earned gains and slow progress toward building wealth. This chapter covers the hidden challenges investors face and reveals why understanding these pitfalls is crucial. By learning how emotional responses and overlooked costs can quietly sabotage success, you'll gain clarity on how to navigate investing with confidence and caution. Recognizing these hurdles early empowers you to build habits that protect your money and set the stage for long-term growth. Now, hear me out. I'm no investor. I invest a little bit of dollars here and there, but I'm really no investor. I'm learning as I go. To be honest with you, I have to study certain things in these websites or these apps, and I have to constantly go over it. Especially when you investing, you gotta kind of stay glued to what you're investing in, and you gotta understand what you're investing in. And if you don't, then you need to do research and ask questions, to the right people, because everybody is not investing in, a lot of stuff. So, and then everybody has different investments for those that do invest. I'm just to a point in my life, and I'm to an age in my life where I should have invested earlier on, but I didn't know nothing about investing anything. I just kind of I develop a habit of liking to read certain things and certain books. And to be honest with you, I don't really know what attracted me to reading, period. But I must say that once you start getting attracted to reading stuff, reading things leads you to something else. Reading leads you to another book to read. Then that book leads you to something else. So reading always leads you to different things. Because I've dipped and dabbed in certain things. I haven't read a lot of books cover to cover, and some books I have read cover to cover. But the moral of the story is, I'm no big investor or nothing like that. I like certain books, and I took a chance on bringing it to my YouTube channel and reading it, because not only is this helping me, it can help somebody else that may not know, that may not even be interested in investing in anything, but at least you're looking at what I'm reading. So somebody's looking at what I'm reading, and maybe they might want to invest sooner or later, but to each his own. Everybody's doing it, taking their own path. And this is just what I like. So this is just what I decided to share with y'all, even including videos and stuff of that nature, motivational videos, because not only am I putting this out there to maybe inspire or to motivate somebody, but this is motivating myself as well. So that's how I'm looking at the whole situation. All right, let's get back to what we was doing. Overcoming emotional traps and the myth of market timing. Many smart investment strategies unravel or because of lack of planning, but because of powerful emotions clouding judgment. The most common emotional traps investors fall into are fear of missing out. They call it short for FOMO. And panic. Wow. So they call FOMO fear of missing out and panic. Each of these can prompt impulsive choices that derail even the most careful crafted investment plans. By understanding these traps, recognizing their signs, and learning strategies to stay objective, investors can increase their chances of long term financial success. Fear, market downturns, and defensive instincts. Fear is a survival instinct that alerts us to danger, but in investing, it often prompts people to flee the market when things get rough. Wow, never thought about it like that. When markets fall sharply, such as during a major correction or recession, negative headlines and steep portfolio losses trigger anxiety. Investors confronting a 15% drop in the stock market might immediately worry, will I lose everything if I ride this out? This fear usually leads to actions like selling stocks at a loss or moving money to cash as a protective measure. That's true. I've heard that before. Real world examples include the rapid sell-off during the early days of a financial crisis or news of a sudden global event. Investors often rush to exit, hoping to avoid further losses, but this often results in them missing the subsequent recovery. Research by behavioral economists like Daniel Kahneman has shown that people are wired to feel losses more deeply than gains. That's true though. I can honestly say that, because when we lose something, that's more of a hard hit to us compared to gaining something. Yeah, we may gain it, we feel a little rush when we gain things, but when you take a hit or something, and maybe you worked hard for it, or that's all you had to your name at the time, yeah, you're gonna feel that deeply. That's very true. Leading to risk adverse behavior during downturns. The effects of giving into fear can be severe. By selling at the bottom, investors turn paper losses into real ones, missing out on future gains when the market rebounds. To counter this, investors should ask themselves, am I acting because of short-term fear, or does the data warrant a long-term change? I don't think a lot of people think like that. Certain people probably do, but a lot of people don't. Taking a pause before reacting, such as committed to a 24-hour waiting period before any major investments move, can help bring anxiety levels down. Writing down the original reasons for your investments and checking if those fundamentals have truly changed offers clarity. A simple checklist can be helpful. Okay, we're going to blow this up right here. Self-check. Is this decision based on headlines? Response needed 24 hours. Wait 24 hours. Are fundamentals still strong? Response needed. Stay the course. Am I following my long-term strategy? Reevaluate only if long-term goals shift. Okay. FOMO. FOMO is fear of missing out, right? We just read that. Urgency and herd mentality. The fear of missing out, or FOMO, strikes hardest during hot investment booms. News of friends making quick profits in trending assets, or seeing a stock's value skyrocket overnight creates this urgent need to join the crowd. Technology stocks in the late 1990s, or cryptocurrencies in recent years, are classic cases where investors felt compelled to buy in, afraid of being left behind, which is FOMO, fear of missing out. FOMO often prompts investors to abandon their regular research or carefully planned strategies. Instead, choices are driven by hype, headlines, and social proof. This can lead to buying at inflated prices, just as excitement is peaking. Inevitably, the excitement cools and prices correct, leaving latecomers with potential losses. To manage FOMO, it helps to pause and ask, what would I still invest in? Would I still invest in this asset if it wasn't popular? Wow, that's a good question. That's something to think about. I never would thought like that. Does it align with my goals and risk tolerance? Writing down your reasons for investing can clearly Writing down your reasons for investing can clarify if the decision fits your plan or is being shaped by envy or social pressure. Many successful investors recommend having a cooling off period for any investments inspired by trends. if after 48 hours the rationale still makes sense and passes your what is this? Hold on. It passes your criteria, it may be worth considering. Otherwise, sticking to your personal investing guidelines keeps FOMO in check. Panic, sudden changes and hasty choices. Panic is a more intense variant of fear, often seen during dramatic market swings over a very short period. When markets crash on breaking news or unexpected events such as a country defaulting on its debt or a pandemic emerging, logic tends to fly out the window. The urge to act quickly can overwhelm any prior planning. Investors in panic mode might rapidly sell off assets, shift everything into cash, or abandon their strategy entirely. Panic-driven trades are usually the result of feeling completely out of control. During the 2008 financial crisis, studies on investor behavior revealed that many who liquidated their investments during the height of fear missed the substantial recovery that followed, often waiting many years to regain their former wealth. Wow. So, I guess it's basically saying make sure your decision making is valid, make sure that it's going to benefit you and not hurt you for short term thinking. That kind of makes sense. Like, do you want to pull your money out? If that's to anybody that has any investments, do I need to pull my money out now or convert it to cash and just hurry and get out? Or do I want to ride this storm out right quick and maybe come out on a better end later on? That's a good way of looking at it. Building emotional resilience means preparing okay. Building emotional resilience means preparing for volatility before it happens. Creating a written investment plan, complete with rules for when and how to rebalance, sets up automatic responses that override panic. Use and remember notes like don't make decisions at market extremes or setting thresholds, e.g., only reviewing portfolios quarterly, not daily. Also helps. Checking in with questions such as, am I acting out of fear or informed analysis? Puts a pause on rash decisions. Recognizing these emotional traps and having practical steps to manage them connects directly to long-term investing success. Emotional discipline supports the steady, consistent approach that research shows delivers better returns over time. Investors who learn to spot their triggers, establish personal guardrails, and stick to their plans can ride out market ups and downs much more effectively. This one, identify high fees and hidden costs and overtrading. Every dollar invested should work as hard as possible for its owner, but fees and hidden expenses can quietly siphon growth from a well-designed portfolio. Even low-sounding percentages, when stretched over years and applied to large sums, can snowball into significant reductions in wealth. Understanding these costs and minimizing their effects is at the heart of smart, cost-conscious investing. Management fees and expense ratios. Investment products, whether mutual funds or exchange-traded funds, ETFs, routinely charge management fees. These fees are typically stated as a percentage of assets under management, known as the expense ratio. For example, a fund with a 1% expense ratio charges $10 annually for every $1,000 invested. Larger portfolios mean higher absolute costs. $100,000 invested at 1% incurs $1,000 per year in fees, regardless of whether the investment performed well. While 1% may not sound like much, compared to a low-cost index fund charging only 0.10%, Over 30 years, the difference becomes dramatic. If both funds return an average of 7% before fees, 10,000 grows to about 54,300 with the 0.10% fund, but only around 45,300 with the 1% fund. A difference of 9,000 just from fees. Damn. This gap widens further with larger amounts and longer horizons. The higher the fee, the more your compounded returns are reduced. Oh, damn. Fees don't end with expense ratios. Some investment products have sales loads, one-time commissions that can take 3% to 6% off the top when you buy or when you sell. For a $10,000 investment, that's $300 to $600 gone before your money even has a chance to grow. Ask if the fund charges any entry or exit fees, and favor non-load funds whenever possible. Hidden and overlooked cost. Not every cost shows up on a product sheet. Brokerage commissions, though lower today thanks to zero commission trading on many platforms, can still add up for frequent traders or those using specialized products. Account maintenance fees such as annual charges or inactivity fees may quietly drain accounts, especially smaller ones or those held in specialized accounts like retirement plans. Taxes loom large as a hidden cost. When investments generate interest, dividends, or realized capital gains, a portion may go to the government. For example, selling a stock that has doubled in value triggers capital gains tax, reducing your net profit. Damn. Frequent fund turnover inside actively managed funds can result in higher taxes passed along to investors, even if they haven't personally sold any assets. Imagine a portfolio producing a pre-tax return of 7%. If annual taxes and hidden fees reduce this by just 1%, the long-term growth drops significantly. Compounded over 20 or 30 years, seemingly minor costs erode a substantial part of the total investment. Ask for a breakdown of all potential account fees before investing. Review fund documents for trading costs and turnover rates. Use online fee calculators to eliminate the total cost year by year. Always check if an account charges for paper statements, wire transfers, or other services. The true cost of overtrading. Frequent buying and selling, often in pursuit of quick gains or to follow the latest trend, comes with a tangible cost. Each trade may incur commissions or spread costs, the difference between buying and selling prices. More importantly, short-term trades often results in short-term taxable gains, which are taxed at a higher rate than long-term holdings. Research consistently shows that investors who trade often tend to underperform buy and hold investors. This underperformance comes from a combination of transaction costs, taxes, and the tendency for frequent traders to mistime the market. Consider two investors, each starting with $50,000. One trades actively making 20 trades per year at $10 per trade, plus incurring 1% in taxable short-term gains. The other makes only 1 or 2 trades annually and holds investments for the long term, paying little in commissions and enjoying the lower long-term capital gains tax rate. Over a decade, the active trader can lose thousands in extra costs and taxes while also risking lower market returns due to mistimed decisions. A guiding principle is to trade only when there's a clear, rational reason, such as adjusting for major life changes, rebalancing, or responding to significant shifts in goals or risk tolerance. Okay. Before executing a trade, ask yourself, does this move serve a long-term plan or is it a reaction to a short-term noise? Cost-conscious investing in practice. To build a cost-effective portfolio, start by listing all possible fees for each investment option. Compare expense ratios, accounting fees, and likely tax implications. And you use online tools like free comparison calculators or portfolio analyst apps to see how small differences in costs add up over time. Ask advisors, what is the total cost of owning this investment for 5, 10, or 30 years? Are there lower cost alternatives with similar performance? Focus on minimizing new trades. Set guidelines such as requiring a written reason for every trade or waiting a week before acting on any new investment idea. Favor diversified low-cost funds or ETFs and consider tax-efficient investment accounts. Regularly review statements for new or increasing fees. Every percentage point saved grows your wealth faster. By making cost awareness a habit, investors keep more of what they earn and avoid mistakes that quietly drain progress toward their goals. Spotting scams and avoiding bad advice. Every investor hopes to grow their money safely, but the investment world contains hidden traps. While high fees can eat away at your returns, deliberate scams and bad advice can cause even bigger losses. Understanding the types of fraud and how to protect yourself is just as important as choosing the right stocks. Wow, that's so true too. Or funds. Recognizing investment scams. Investment scams often use the excitement of high profits or new opportunities to draw people in. Some of the most common schemes include Ponzi schemes, pump and dump operations, and fake investment opportunities. Ponzi schemes promise big returns with little risk and generate profits by using money from new investors to pay earlier participants. Wow. Bernie Madoff massive fraud is a well-known example, but many smaller versions target ordinary people every year. Pump and dump operations involve hyping up a stock, often through social media or emails, to drive up its price. Then the fraudsters sell the shares, making a profit while everyone else is left with worthless stock. Fake investment opportunities come in many forms. Fake investment opportunities come in many forms: phony real estate deals, fraudulent cryptocurrency schemes, or imaginary startup investments. Scammers create slick websites and convincing materials to make these fake investments seem real. That's kind of crazy. That's kind of wild how we live in a world like this where you don't know what's real and what's fake. That's why I was telling y'all earlier about how I do my own research and stuff. Like, you got to do your own research and really look at websites or apps, make sure stuff is real. Because people like they said, people promise you, oh, if you only invest $500, I can make you $6,500 in an hour, 2 hours. Like, them Jones be fake as hell. But it be people out here like that. It be people all on social media doing that. Or, do you know how to trade? Do you trade this and that? And they want all your information and all that, and they don't have no type of. You can't really trust their profile because they can put any picture on the profile and say that's them, and then they get your money and they disappear. Like, that's one thing about the internet. You can be in and out on the internet. You can disappear quick on the internet. You know what I'm saying? Like, it's so easy for people to scam on the internet. It's so, it just don't make no sense. Okay, spotting red flags. Even though scammers routinely update their tactics, there are recognizable warning signs that wise investors learn to spot. Some common red flags include promises of guaranteed return. That's just what I was talking about. No honest investment can promise you a specific profit, especially high or risk-free returns. See, I was just talking about that. Because you got a lot of people on social media doing that. They'll send you a DM and Oh yeah, you know how to, you know, if you pay $80, I can get you $10,000 back, and all this bullshit. No high risk, high reward should always set off alarms. Yeah, should always set off alarms. Yeah, no risk, high reward should always set off alarms. High pressure sales tactic. If someone insists you must act immediately or you will miss out, they may be trying to prevent you from thinking things through or asking questions. That's another good one. Unlicensed or unregistered advisors. Many scams are operated by advisors or companies with no legal credentials or official registration. Complex, difficult to understand strategies. Scammers often try to confuse victims with jargon or complicated explanations so you feel embarrassed asking questions. Exclusive or time sensitive opportunities. If if only you are special enough for an opportunity or there's a ticking clock, step back and verify the claims. Alright. Evaluating financial advisors and information. Before working with someone who will handle your investments or advise you what to buy, it's essential to check their background and qualifications. There are clearly steps you can take, credentials and registrations. Always ask for proof that advisors are registered with the proper financial authorities. I don't even think a lot of people go that far to ask people that. In many countries, advisors must be licensed. In the U.S., for example, registration with the Security and Exchange Commission, so that's what that means, SEC, Security and Exchange Commission, or the Financial Industry Regulatory Authority, that's FINRA, is required by many professionals, if they really professional. Background checks. Many countries provide free tools to look up financial advisors. In the U.S., in the U.S., I'm sorry, y'all, I'm just messing. Okay, in the U.S., you can check the SEC's Investment Advisor Public Disclosure website or FINRA's Broker Check database. These sites reveal if a person or company has a clean disciplinary record. Questions to ask. What are your credentials and licenses? How are you compensated? Are you required to put my interests ahead of your own? And then this one is fiduciary duty. Can you provide references? That's so good. I like this right here because I don't think a lot of people ask them type of questions, especially when people approach you online about, oh, I can do this for you, or you can risk low and I'll pay you high, and that's so good. I like that. Reliable information sources. Be wary of viral articles, aggressive salespeople, or self-proclaimed experts without proven backgrounds. Trusted financial news outlets, government resources, and large, reputable financial institutions are safer sources for investment information. Real world scams in action. All right, I'm going to stop right here. We're going to bookmark this, y'all, because I'm a little tired. I need to get me some rest because I got things to do tomorrow. And we're going to pick up where we left off on real world scam in action. So I hope y'all learned a lot. I hope y'all enjoyed my reading. And always remember FOMO, which is fear of missing out. Before anybody that's an investor or that's becoming an investor, before you make a decision to withdraw your stuff and put it into immediate cash, ask, is this for a short term thing? I'm just in panic or fear of something gonna happen, or do I need to, or should I ride this out, and come out better on the back end? I don't think a lot of us even think like that, because most of the time when, especially of news come on, or breaking news and this and that, yeah, a lot of people will pull their money out. A lot of people do, say forget it and just draw their money out and keep it pushing, but that was something for me to think about there too. Like, is this worth drawing out? Is this worth me cashing out and just taking my money and leave and go do something else? Or do I just leave my money there and just ride this little storm out right quick and I'll still, come out bigger and better most likely. That's something to really think about. But until next time, y'all take care of yourself, and I'll talk to y'all shortly. I'm out. Peace. And once again, this is from the book 101 for Friendly Beginners on Investing. All right, y'all. That's my time. Peace.